For my project, I looked at the efficacy of using existing stock market models to predict cryptocurrency. So in my project, I looked at 5 different market events and their effects on specifically Bitcoin. I first created a model that explained the S&P 500, so a very commonly cited market index, and then I used that same model to see if it could accurately predict Bitcoin. To create the first model for the S&P 500, I used a regular frequentist MLR model, and for the Bitcoin, I used a Bayesian MLR model, similar to the one we used in class at the end of the last lecture. Bitcoin and other cryptocurrencies are still relatively hard to predict. As a result of that, they're often not predicted accurately by existing models. The regular market, however, can largely be predicted across large time intervals as a result of a large amalgamation of historical data and current monitoring. So accurately predicting cryptocurrencies such as Bitcoin can lead to significant profits due to the high volatility in it, but also its relatively new status, which leaves a lot of opportunity for growth and new development. So Bayesian models are especially effective for market outcomes because they can continuously incorporate new data to generate better predictions. This is how we got a lot of the existing data about other market indexes. So Bayesian neural networks specifically have seen significant success in predicting various parts of the market, but they can still require more work on which features to analyze when it comes to cryptocurrency. So basically which variables it actually takes into account and what weights it assigns to those. So I looked at the data monthly from September of 2010 to March 2019. So the 5 indicators were first the interest rate, so the Federal Reserve target federal funds rate. This doesn't change every month, but it changes decently frequently to the point where it can reflect a lot of the changes in these market models. So the second is job forecast, so the monthly releases from the federal government about projected job increases or decreases for that month. The third is a binary variable on whether or not it was a presidential election year. The fourth is the price of gold for that month. And the fifth is the unemployment rate. So to create the model, I tried various combinations of the 5 indicators, including multiple interaction terms, and I determined that the following model was the most appropriate. So the response variable of price was modeled with the first 3 indicators serving as quantitative explanatory variables and the final 2 as an interaction term. So I also tried other models, such as trying to predict the log odds using a logistic regression, and I also tried modeling the percent changes in these indexes. However, a lot of these indicators tend to not be sufficient and not be very good in general at predicting these kinds of things. They tend to be only effective in predicting the actual prices. So this poses somewhat of a problem in being able to actually compare the 2 regression models, but this was effectively the only way to actually get a proper model for the S&P 500 and therefore a proper model for Bitcoin. So the model did very well. Its R squared value was 98.2%. The F test showed that the model with all 4 predictors was highly significant in explaining the price of the index, and every other predictor is highly significant, whereas the jobs predictor is only significant at the 0.1 alpha level, but that was still sufficient to proceed with the analysis. From the model assessment, there weren't any clear violations found in the assumptions. So this is the Bayesian model. So I used the same prior for all 4 response variables, and the posterior distribution does not in fact have a closed form expression, but it is as follows. So before I get into the rest of the analysis, I first want to go over some possible model violations. So financial models especially have a very, very high chance of multicollinearity due to various market events being intertwined. I chose indicators based on VIF values to minimize the variance of the slope estimates, and therefore the nature of those predictors is still a limitation on determining the exact slope values. However, because both models will have the same issue, they can still be compared. So basically, even if the terms interact with each other and are highly correlated, they are highly correlated in both models, so it is still okay to assess those differences. So because the posterior had no closed form expression, you had to sample, so I used 10 chains. Originally, I didn't have thinning, but I added it after I saw a lot of stickiness, likely due to multicollinearity that I mentioned before. So one thing to note is the high sigma value. This is largely expected given the high volatility of Bitcoin. However, it is still possible to draw conclusions from the calculated values of the slopes because I was able to calculate a pseudo R squared value, basically analogous to the frequentist MLR R-squared value, which basically shows what percentage of the variability in the response variable is explained by the model. So I calculated this by using 1 minus residual deviance over the null deviance and got a value of 0.65, which is sufficient to say that these slopes, even if they aren't exact, do provide some estimate of the relative magnitude and the direction in which these different predictors affect the price of Bitcoin. However, I wanted to try to decrease sigma as much as I can, and given that quick crashes in Bitcoin are largely due to very specific and oftentimes predictable events, I reran the model excluding any changes of over 20%. So this model saw a marked improvement with the pseudo R-squared value changing from 0.65 to approximately 0.8. I also removed the interaction term because it had significant variance and it had clearly no consistent effect on the model. Its confidence interval was very wide. This also significantly decreased sigma. It's still pretty high, but it's a lot lower than it was before. So now I'm going to go over the different predictors and see what the comparable effects are. So first on the jobs report. So the jobs report slope for both Bitcoin and the S&P 500 were both positive and have relatively small magnitudes. Even if this doesn't allow for significant predictive ability for large parts of the overall price, it does allow for more accurate prediction of the direction in which the currency will go. So the S&P 500 mean was 0.15, and the Bayesian 95% interval is below, and its mean was 5.796. So both of them, again, are positive and have a small effect. So for the federal funds rate, it does seem to have a very high positive effect on Bitcoin that is effectively proportional to the effect on the S&P 500. However, the limit of this information is that this is only largely valuable when the federal funds rate actually changes, because it doesn't change incredibly frequently. Because otherwise it basically just indicates a general trend as opposed to a monthly one. However, it is still effective to be able to understand where the currency is looking at over longer periods of time. So in terms of a presidential election year, it doesn't seem to have a very consistent effect on Bitcoin at all. So given that this tends to be a very consistent predictor of regular markets, the information is actually pretty important for not just monthly predictions, but also longer duration ones. Often investors tend to place a lot of bets on the fact that being in a presidential election year does have a significant effect, and so it's important to be able to remove this from the. So this model is largely limited by only considering one index in addition to only looking at monthly data. This limits the predictors to only being able to analyze more long-term investments. So monthly may not seem like long-term, but for things like Bitcoin, a lot of the money is going to be made on a day-to-day or even hour-by-hour basis for things like trading algorithms and larger financial institutions. However, this is still valuable to a large extent because you're able to still make some relatively short-term investments by month, and it's also effective to be able to predict where the cryptocurrency is going to go, even if you aren't actually investing in it. This can be valuable for analyzing cryptocurrency's stability to be able to be used as an actual currency, or generally its stability when you're a programmer trying to develop tools that incorporate it. So following this, I want to do 2 areas of research. So I first want to add this to Quantopian to basically see how effective the model can be in the future. And I also want to see how the model updates over time. I also want to incorporate this into a Bayesian neural network, basically just being able to use machine learning to acquire a significant amount of new information and data effectively continuously. So second, I want to see how other similar cryptocurrencies are affected by market predictors, especially given that they have a lower trading volume. Bitcoin is traded very frequently and is more susceptible to market events, which is what makes it easier to analyze. This is basically because more people trade it, and therefore those people tend to be more exposed to these events. However, other cryptocurrencies can be hard to predict, but it would be interesting to see which predictors do affect them.